Let's just go ahead and get started. I'm going to introduce Sarah Murphy, who is our workshop leader. Sarah, why don't you tell us a little bit about yourself and about sustainable and responsible investing and what's the current trend and how is that developing in the business world?
Sure. Thanks, Lauren. I appreciate it. I am an independent consultant on sustainable investing. I've been in this industry for 16 years, previously on the asset management side. If we look at the history of SRI, it helps us to understand where it is today. It actually started out in the religious arena where churches and other religious institutions wanted to align their financial management with their values. And so some of the earliest mechanisms for doing that were simply by an exclusionary pathway. So to eliminate investments and activities that the group didn't sanction. So for instance, things like weapons, later as technology developed, abortifacients, things like that. But over time, as more groups got involved in this and investment according to one's belief system and values became more mainstream, it also became a mechanism for seeking out investment opportunities. And my assertion is that today it has become a value-adding strategy if it's handled correctly, and that it can actually improve on returns for your portfolio if you do it properly. That having been said, it's also tricky because SRI is something of the victim of its own success. 15 years ago, analyzing companies for their sustainability behaviors was easy enough. You had all kinds of tools at your disposal. Looking at a company's website actually gave you a fairly honest snapshot of what it was doing. You could call up a factory floor and talk to workers and get the real scoop on labor conditions. But as SRI became the world's most quickly growing asset class, and that's really true by orders of magnitude, suddenly everyone wants to be the SRI darling because there's a lot of money going into that space. Even though it's still very small compared to the conventional market, it's growing quickly. But it makes the analyst's job really, really difficult because now we have entire PR machines behind slick websites and great messaging campaigns that really sort of obscure the actual state of affairs going on behind the scenes at a company. It's sort of like the organic food label in that regard. I'm sure you all have followed that, especially in the United States context, where basically the USDA standards can be really comfortably manipulated to get the label, and a lot of the sort of purists feel that it's even harder now because of the standard to get access to what they really meant by organic food. Same thing's happening in this space. But it's worth taking a step back to consider what investment is. In the purest sense of the word, you're buying a piece of a company ostensibly to promote its growth over time. There's an interesting thing to consider. Back in the 50s, the average length of time that a given share was held in an individual owner's hands was around 9 months, depending on when you looked at it. Today, it's actually mind-blowing to consider how long it is now. It is a fraction of a second. This is because of high-frequency trading and all of the computer technology behind the way we trade shares at the moment, which really works against sustainability. But for longer-term asset holders, it's really something where you want to invest in a business and you buy and hold good businesses. So having said that, it's worth talking about core business. My personal belief is that the SRI space and the analysis of it has gotten into a little bit of a quagmire around metrics and data and the attempt to quantify absolutely every possible aspect of a company's behavior and the way it conducts its business. There are some investments advisors and asset managers who use hundreds of data points in complex models to assess sustainability of a company. And I feel that at a certain point, they lose the forest for the trees. I think sometimes you have to step back and just ask, what is the company's core business? What does it do? To what extent does its product or service contribute to sustainability or detract from it? Is this company solving a problem or is it creating one? And when you start to ask those questions, I think you get a lot closer, not only to understanding the real sustainability of a business, but also to understand its value added and its prospect for long-term growth and to contributing to your portfolio. In a classroom setting, I would posit this poll question because I think it teases out a lot of important issues. The question of whether or not morality should be a factor in investment decisions. And I am going to reserve my judgment on that one. Maybe that's something we'll talk about after the presentation if you're interested in that. Moving on, I think that a big part of SRI is around managing risk, and there's no better example than that of climate change, especially right now. This past year has been a really, really important one for climate change itself, the science behind it, the legislation around it, the shifting in public opinion, and also in actual tangible impacts on companies and their business models. A lot of companies still think it's not a risk, but the SEC is requiring disclosure in companies' annual filings. They are supposed to directly address the risk around climate change. Now, that's got a long way to go. Most of them just talk about the risk of regulation rather than looking at things like risk to their physical infrastructure, risk to their business model. And that's nowhere more clear than around the issue of unburnable carbon and stranded assets. I'll explain briefly what that means. If you look at things like oil and gas companies in particular, they base a lot of their valuation, in fact, the vast majority of their valuation that goes onto their balance sheet, in part on their hydrocarbon assets. They value those, and that becomes a part of their balance sheet. Now, that's all well and good if, in fact, every single molecule of their hydrocarbon assets is, in fact, exploitable. The problem is that if we go into a framework of global governance around climate change, and if we actually put into place some real action to try to constrain global warming, particularly within the 2 degrees Celsius model, by most estimates, these companies can only burn about a third of what remains of their hydrocarbon assets, depending on the source. This leads to a scenario of what's called stranded assets, which is actually a known concept in the investment world, where you have assets that you cannot use. And if you cannot use them, you cannot possibly value them on your balance sheet as part of your assets. It's sort of a doomsday scenario if it actually plays out. Meanwhile, you have another area, social license to operate, which is the concept of, this gets much more into the human rights space, where we see companies operating particularly in less regulated areas of the world, typically developing countries, where they basically go in and they don't involve the communities in which they operate. They don't take care of the environment around their operating sites, and they face an eventual backlash. This is particularly true with extractive companies. It used to be all metals and mining. Now it's a lot of oil and gas, and increasingly agricultural companies. So you can look at a principle called free, prior, and informed consent. That's actually the benchmark strategy for companies managing this type of problem. It's a process of community consultation where they can get folks involved in being a part of the business development, but also having buy-in. And it's a great way to prevent some of the problems that we've seen with companies in the past. Maybe no better example than Shell operating in the Niger River Delta. If you'll allow me a brief anecdote, I'm sure you're all familiar with the fact that Shell oil has basically spilled all over that area, really, really, truly undermining a lot of agricultural land, livelihoods. It's actually quite a disaster. And I remember once sitting in a room with a bunch of the senior vice presidents from Shell, and I asked them about this. I said, "What's going on? You got oil leaking all over the Niger River Delta. How do you account for this?" And their slick answer, because of course, they've got a huge machine behind them, and they've had lots of time to think about how to spin this. Their slick answer was, look, this isn't a problem of aging infrastructure. This isn't our fault. This is the result of sabotage on the part of the local population. And they sort of expounded for a while. And I ultimately said to them, I said, you mean to tell me that you have such terrible relationships with the local population there, that they're actually sabotaging, they're cutting off their nose to spite their own faces. They're busting open your oil pipelines and thereby undermining their own livelihood because they hate you that much? This is your great answer? And, sort of had a speechless moment in the room. So this is really something to consider because they're losing their primary asset under that scenario. We can also look at things, reputational risk is a big one, especially for major global brands. If you're ignorant as to how your supply chain is working, where things are coming from, and potential for things like child labor taking place in your supply chain, your brand can be undermined. We've seen it with Nike. More recently, we've seen it with textile companies, and the backlash from consumers can be problematic. Meanwhile, there's also opportunity behind this more than ever before. So that, each thing that I just talked about presents a flip side if companies handle it properly. Some of the issues around agriculture and energy challenges that we've been facing around climate change actually converge to support an industry if folks are able to perceive the trends and respond correctly to them. And this is maybe the crux of the argument from a value added perspective. If you consider that sustainability and looking at it through the investor's lens is all about identifying major trends that are they haven't yet appeared on the radar of conventional investors because they're not taking an ecosystem analysis approach, then the theory is that you can see a trend that's going to affect stock price before the rest of the market has priced it in. There's your value added argument. And so there are these major industries that are growing up around the challenges we've just discussed. Carbon capture and storage, while I still have major reservations about its long-term durability, is something that's cropped up because of this challenge. Energy efficiency behaviors, an entire sea change in the way that our utility grid is going to look in, say, the next 10 to 15 years. All of these are results of seizing opportunity. And you can watch utilities behaving very differently. You look at NRG Energy. I was talking to their, love that name. I was talking to their CEO. I was asking him about his concerns around rooftop solar, which fundamentally, if you project it out, guts the traditional utility business model. And he basically said that he's actively engaged in the destruction of the entire way his company has always worked, and he's going to be a part of the future. Now you take that and you lay it next to other utilities who are basically clinging tooth and nail to a system that is dying. And it's really quite remarkable to see it's not hard to imagine which ones are going to succeed and which ones are going to fail. With respect to the social license to operate concept that we just discussed, an unexpected opportunity arose for a company that begrudgingly got involved in trying to deal with those problems. Some of you may remember that the name Rio Tinto used to be associated with all kinds of horrible things. They're a mining company. About 10 years ago, they just kind of got sick of activists and being berated in the press. I can't say that they had any better reason than that, according to a lot of their executives. But they started dealing with this a lot more seriously, doing community consultations and getting buy-in. And the amazing result of that down the line that they hadn't foreseen is that now they're getting offered preferential access to new parcels of land, new exploitation opportunities by governments that recognize them as a good partner. So this has created a business opportunity that they just didn't see coming. They just did the right thing, and look what happened. And meanwhile, you can look at if you all remember some of the horrible incidents around the textile factory fires in Bangladesh, which, by the way, have been going on for years, but the most recent one was really quite dramatic. We saw a real difference in the way European companies versus U.S. companies responded to that situation. And the European companies really sort of got behind trying to formulate a better best practices system and a voluntary organization that would have dealt with some of the risks involved and the reasons why those fires kept happening. Whereas the U.S. textile companies went on the defensive, and that their brands really suffered for that as well. Monsanto is almost too easy a target, but you'll all notice what's going on in the news right now with their problems with glyphosate and everyone finally admitting that it might be a carcinogen, which we've known for years. Their reputation has taken a hit, and they could have dealt better with that. This is one that I really like. It's maybe not so much innovation in terms of product design, but more in terms of systems. What you're looking at is a map of the U.S. rail system. And the reason that I put this up is to illustrate how this sort of systems thinking can lead you to perceive opportunities that you might not have otherwise noticed. So we're looking at the U.S. rail infrastructure. It's a few months old, but basically as it stands today. And the reason this is fascinating to me is that over the last 2 decades, agricultural production has been growing the most in the Northwest. Meanwhile, agriculture depends thoroughly on rail transport to move the goods around the country. Rail is by far the most efficient and cheapest mechanism by which to move agricultural products. It also has the least greenhouse gas emissions compared to other modes of transportation. Meanwhile, you might be aware of the fact that a lot of unconventional oil and gas development is also moving up in that direction, particularly around tar sands up in Canada. And as you all know, in the wake of the dismissal of the Keystone XL pipeline, oil moving by rail is a thing that basically is here to stay. So the problem that we have with that situation is that there's a real chokehold on capacity movement taking place up there in the Northwest. And oil is sort of edging out the movement of agricultural products. even as we're having a lot of crop failures in Canada, which is our breadbasket, because of the drought. So there are a lot of sustainability issues packed up in what I just said. But basically, if you're a rail operator, you need to be looking at this map and looking northwest. And so should investors. And they should be looking at folks who are understanding that dynamic, but also who are practicing more, who are looking into rail safety, particularly around all of the tanker explosions that we've been seeing with such tragic results. That's just a single example. One of the challenges with this, and I've made a really rosy case here, and I should say, when I was on the asset management side, I can tell you that running a fund running multiple funds with this sort of framework in mind, we outperformed. Now, again, you have to be careful about single factors, but what my basic takeaway is that an SRI strategy had us outperforming our benchmarks, and we didn't use SRI benchmarks. We used conventional benchmarks. So we had a lot of clients who were with us just because of our performance, not because they even cared about sustainability. So that's a really nice case to be able to make. Having said that, I don't want to be naive here. Some of the worst abuses that we see don't register in stock prices to any meaningful degree. Some of you may have followed the recent case with Chevron in Ecuador. It's really hard to overstate the amount of environmental damage that they did there, and also damage to communities. And one of the largest lawsuits came against that company in history, and investors just didn't care. The stock price barely moved. Same thing with Shell in the Niger River Delta. After what I just told you, that company is doing fine. And Monsanto, for as much as it suffered a little bit on glyphosate, for all of its really, really horrendous behaviors, particularly as relates to small farmers, they're doing great too. And so, here again, what I often do with in the student setting is I'm going to ask you, if it doesn't hurt the stock price, does it matter? And I think that's really something worth considering, because it's great to make the values argument, but it's actually not really something that tends to bring a whole lot of people to the table. The question of whether or not SRI creates outperformance is an important one. As I've just told you, I've seen it. I think that it's real. I think that when it's done as a really thoughtful ecosystem approach, it works the best. I'm fairly dismissive of the heavily data-driven approach. In and of itself, data matters, but it shouldn't be the only thing that drives your approach. And of course, there's no right way to do SRI. There's no sort of absolute truth behind any of this. There's no such thing as a perfectly good company nor a perfectly bad one. Even using those words is almost more of an emotional thing. So depending on what factors you choose to emphasize, you're going to have different outcomes. There are a lot of attempted studies to try to evaluate this question once and for all. Again, it's really hard to isolate these factors. What we've seen is that you can say that companies that report on sustainability slightly outperform, and that's been fairly well demonstrated. When you think about that, if you take that to the next logical step, everybody knows in business school that you don't manage what you don't measure. And of course, you can't report on sustainability if you haven't measured at least some of your outcomes and some of your inputs. So there's some sort of case to be made there. But really, I think that the power in this is in what I was describing before, the ability to identify trends before the broader market has seen them coming, and to plan that into your investment strategy. What I would cover now, and what I'm happy to cover, is a couple of trends that are taking place in this space right now. For instance, the proxy voting season, where investors are able to vote their proxies at companies' annual meetings, and activist investors using that shareholder resolution opportunity to advance social and environmental agendas. This is a fascinating trend, and it's really starting to make waves in corporate boardrooms. We can talk about the notion of top-down versus bottom-up analysis. So when you're considering sustainability, do you start from major themes and filter them down to how they affect companies? Or do you start with companies and try to extrapolate their behaviors to broader trends? I would argue you do both. And I've already spoken a little bit about data providers and their checklists, and how that creates a certain burden on companies. If there are questions I can answer, and let's have a discussion.